In this video, I'd like to show you a post-closing trial balance. So in previous videos, we talked about how accountants at the fiscal year end will close nominal accounts such as revenues and expenses and dividends. They will close these accounts out to a real account called retained earnings. And if the firm's never had any profits, then the account would be called accumulated deficit. But it's the same idea. These temporary accounts, revenues, expenses, dividends, they're just tracked for a single period before they're closed out. Their balances are closed out to this retained earnings account, which is a permanent account, which tracks all the earnings that the firm has ever had since the firm's beginning, less any dividends. So I want to show you an adjusted trial balance for a company that was just, let's just say that it was a startup, it was its first year of operations, and the fiscal year end is December 18th, 2018, and so we've got an adjusted trial balance that the accountants put together, and I just want to show you what happens and how we get to a post-closing trial balance after the closing process. So all of the accounts here are temporary accounts. Dividends, revenues, and expenses. The trial balance isn't always going to have them all at the bottom. I just put that there so it'd be easier for you to see. But you're basically going to take dividends. You've got a debit balance of $5,000, so you're going to have to credit it for $5,000, and then you're going to debit all the revenues. There's $106,000 in revenues, and then there's $73,000 in expenses. And so what you're going to do is you're going to close out these accounts. So with dividends, you would credit dividends for $5,000, and then you would debit the account that gets debited. Remember, the thing that you're closing things to is retained earnings. So you would debit retained earnings for $5,000, and then we're debiting revenues for $106,000, and then we're crediting expenses for $73,000. I'm just lumping all the expenses together. In reality, the accountant would do them individually. I just want to make it easy for you to see. And then we have, to make this balance here, we need $33,000 credit, and so that's going to be retained earnings. So the ultimate effect is that we have retained earnings goes down $5,000, it goes up $33,000. So the net effect is we're going to have an increase in retained earnings of $28,000. And retained earnings isn't mentioned here because the company just started up, so the beginning balance was zero. So the balance, the ending balance of retained earnings would just be $28,000. And so what we're going to do, all these accounts here that are temporary accounts, they're all going to go to zero. So in our post-closing trial balance, we better not see any of these accounts, right? We don't want to see any of these here because we're supposed to bring them to zero. And then what we're going to do is we're going to transfer the net effect of everything from zeroing all this out. That was that $28,000 in retained earnings, right? So in our post-closing trial balance, we're not going to have any of these accounts, and we're going to have a retained earnings balance. So let's see if we got our retained earnings of $28,000 that we calculated, and then we see that it's actually our post-closing trial balance is a lot smaller, right? And the reason is that it doesn't have any temporary accounts. There are no temporary accounts in the post-closing trial balance. So what we've done is we got rid of all our revenue accounts, our expense accounts, etc. Now, they're not getting rid of permanently, right? So because this new year, so January 1st, 2019, our revenue account starts at zero. So like that service revenue, that starts at zero, but then we're going to make sales. I mean, hopefully, if our company's doing well, we're going to make sales, and we're going to begin tracking the revenue and expense accounts and the dividend account. We're going to begin tracking them again as of January 1st, 2019. We're going to track them for 2019. And at the end of 2019, we're going to do the closing process again. Every time you get to the fiscal year end, you take all those temporary accounts and you transfer them to the permanent account of retained earnings. And so then the post-closing trial balance for your company, it will not have any revenues, any expenses, any dividends. It won't have any temporary accounts at all. All of the accounts that are on the post-closing trial balance are real/permanent accounts. And that means they're all going to appear on the balance sheet, right? So you got assets, you got liabilities, and you got stockholders' equity accounts are the only accounts you're going to see on the post-closing trial.